Homeowners insurance is one of those financial tools that sits quietly in the background until the moment you desperately need it. At its core, it is a contract. You pay a regular premium to an insurance company, and in return, that company agrees to help cover the financial cost of certain unexpected events involving your home, your possessions, and your personal legal exposure. The key word there is unexpected. Homeowners insurance is not designed to handle routine maintenance, gradual wear, or predictable deterioration. It exists to shield you from sudden, significant losses that could otherwise take years to recover from financially. Most standard homeowners policies are built around 4 fundamental areas of protection. The first is the structure of your home itself. This is commonly referred to as dwelling coverage, and it pays to repair or rebuild the physical structure if it is damaged by a covered event. Things like fire, windstorm, hail, or vandalism. Attached structures like a built-in garage are typically included, along with fixed interior features like flooring, cabinetry, and built-in appliances. The second area covers other structures on your property that are separate from the main home. A detached garage, a garden shed, a fence, or a guest house would fall into this category. Coverage here is usually set at a percentage of your main dwelling limit. The third area is personal property, the contents of your home, furniture, clothing, electronics, kitchen appliances, and most everyday possessions are covered if they are damaged or stolen under qualifying circumstances. The fourth area is liability protection. If a visitor is injured on your property, if your pet causes harm to someone, or if you accidentally damage a neighbor's property and a legal claim follows, liability coverage can help pay for your legal defense and any resulting settlement up to your policy limit. Sitting alongside these 4 is an often overlooked but genuinely valuable component called additional living expenses coverage. If a covered loss makes your home temporarily unlivable, this portion of your policy can help pay for a hotel, rental accommodations, and the added daily costs of being displaced while repairs are completed. To fully understand what your policy does and doesn't protect you from, it helps to understand the concept of a peril. A peril is simply the event or cause that triggers a loss. Fire, theft, wind, water, and so on. Some policies are written to cover only a specific named list of perils. Others are written on what is called an open perils basis, meaning coverage applies to everything except what is explicitly excluded. Open perils policies tend to offer broader protection for the dwelling structure. Personal property, however, is frequently covered on a named perils basis by default, unless you request and pay for broader protection. Exclusions deserve just as much attention as the coverage itself. Water damage is a good example of where people are often caught off guard. Water damage resulting from a sudden internal event, like a pipe that unexpectedly bursts, is generally covered. Water damage caused by external flooding, meaning water rising from outside the home, is almost universally excluded from standard homeowners policies and requires a completely separate flood insurance policy to address. Earthquakes are similarly excluded in most standard policies, and homeowners in higher risk regions need a separate earthquake policy or a specific endorsement to have that protection. One of the most consequential decisions you will make with homeowners insurance is selecting the right dwelling coverage limit. A mistake that catches many people off guard is basing this number on what their home would sell for rather than what it would actually cost to rebuild from the ground up. Market value reflects land, location, and real estate demand. Rebuilding cost reflects construction labor, materials, permits, and the specific features of your home. In a hot real estate market, your home might sell for far more than it would cost to rebuild. In other areas, the reverse can be true. What matters for insurance purposes is the rebuilding cost, because if your home is destroyed, you are not buying land again. You are paying contractors to reconstruct it. If your dwelling coverage limit is set too low, you face the risk of being underinsured, which means absorbing a significant portion of rebuilding costs out of your own pocket. Insurers often provide tools to estimate rebuilding costs. But if you have renovated, expanded, or upgraded your home since the policy was written, those estimates may be outdated. Closely related to the coverage limit is the question of how the policy pays out, specifically whether it pays on a replacement cost basis or an actual cash value basis. Replacement cost coverage means the insurer pays what it would cost today to repair or replace the damaged item with something of comparable quality without reducing the payout for age or depreciation. Actual cash value coverage factors in depreciation, so an older roof or a 5-year-old appliance would receive a payout reflecting its current diminished value rather than the cost to replace it new. For most homeowners, replacement cost coverage provides meaningfully stronger protection, though it does typically carry a higher premium. Some policies also offer extended replacement cost on the dwelling, which provides a cushion above the stated coverage limit, useful when a widespread disaster causes construction costs to spike sharply in a short period of time. Deductibles are another area worth understanding clearly before you need to use them. Your deductible is the amount you absorb out of pocket before the insurer steps in to cover the rest. Choosing a higher deductible will generally reduce your annual premium because you are taking on a greater share of smaller losses yourself. Most homeowners select a deductible they could realistically manage in an emergency without financial strain. One nuance worth knowing is that in certain parts of the country, particularly along coastlines or in areas prone to severe storms, policies may carry a separate wind or hurricane deductible that works as a percentage of your dwelling coverage limit rather than a flat dollar figure. That distinction matters because on a home insured for $300,000 with a 2% wind deductible, your out-of-pocket exposure in a major storm could be $6,000 regardless of what your standard deductible is. Liability protection is the part of a homeowner's policy that many people undervalue until they actually need it. If someone slips on ice on your front steps, if a tree you own falls onto your neighbor's car, or if your dog injures a visitor, the resulting medical bills and legal costs can escalate quickly. Liability coverage handles your legal defense costs and any covered settlement up to your policy's limit. Most standard policies include a base liability limit, but increasing that limit is typically one of the more affordable upgrades available. Homeowners with significant savings, investments, or other assets often go further and add a personal umbrella policy, which layers additional liability coverage on top of both the homeowners and auto policy limits, and can provide protection into the millions for a relatively modest annual cost. Something that surprises many homeowners is how standard policies handle high-value personal property. Jewelry, watches, fine art, collectibles, Musical instruments and similar items often have specific sublimits within a standard policy, meaning even if your total personal property coverage is generous, any single piece of jewelry might only be covered up to a fraction of its actual value. The solution is to schedule those items individually on the policy, which involves listing them with appraised values and typically provides broader coverage, lower deductibles, and protection for a wider range of circumstances, including accidental loss. How insurers calculate your premium reflects the risk profile of both the home and the homeowner, the age of the home, the construction materials, the condition and age of the roof, the proximity to fire hydrants and fire stations, and the geographic risk of the area all factor in. Credit-based insurance scoring is used in most states as well, as research has shown a correlation between credit patterns and claims frequency. Homes in wildfire-prone areas, hurricane corridors, or regions with frequent severe hail face higher premiums, stricter underwriting standards, and in some markets, limited insurer availability. This makes it worth shopping your coverage periodically, rather than simply renewing automatically year after year. People often make a few predictable mistakes with homeowners insurance. One is setting dwelling coverage based on purchase price or mortgage balance rather than actual rebuilding cost. Another is ignoring the deductible structure, particularly percentage-based deductibles in storm-prone regions, which can create unexpectedly large out-of-pocket costs after a claim. A third is failing to review coverage after significant life changes. A major renovation, a valuable purchase, a home business, or a trampoline or pool addition can all change your risk profile, and your coverage needs meaningfully. And a fourth is assuming all water damage is covered, which leads to unpleasant surprises when a flood-related claim is denied under a standard policy. Homeowners insurance can also be extended through endorsements, optional additions that broaden your protection in specific ways. Sewer and drain backup coverage addresses damage from water backing up through pipes, which is a common and expensive issue that standard policies typically exclude. Water service line coverage can help with repairs to underground pipes running from the street to your home. Equipment breakdown coverage can address certain mechanical failures of systems like HVAC or electrical. These endorsements are generally affordable and can close meaningful gaps, depending on the age and characteristics of your home. At its foundation, homeowners insurance is about your ability to recover. A well-structured policy gives you the financial capacity to rebuild after a fire, replace belongings after a theft, and defend yourself after an unexpected liability claim, without dismantling your savings or your long-term financial plans in the process. The most effective policy is not necessarily the least expensive one. It is the one with a dwelling limit that reflects true rebuilding costs, deductibles you could realistically handle, liability protection that matches your exposure, and endorsements that address the specific risks your home and lifestyle carry. Reviewing your coverage once a year, especially after renovations, major purchases, or shifts in local construction costs, is one of the simplest ways to make sure your protection keeps pace with your actual needs. If you want, tell me what state your home is in, whether the home is newer or older construction, and whether it is mortgaged or fully owned. And I can walk through a practical framework for thinking about the right coverage structure for your situation.